Hello, everyone out there in podcast land. Welcome back to Adventure Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on Wefunder, but also the different resource providers and mentors helping founders along the way. Huzzah! In this interview, we chat with Greg Miaskiewicz, the founder and CEO of Capbase, which helps founders avoid mistakes in incorporating and early stage recruiting, cap table management, and much more. Before we get on with the podcast, we're required to let everyone know that anything we say here should not be interpreted as investment advice, recommendations, or soliciting investments in any company. All companies raising on Wefunder are given an equal opportunity to participate in the podcast based on the progress of their campaign. Wefunder gang, take it away.
Hey everyone, welcome to another episode of Adventure Capital. We're joined today by Greg Miaskiewicz, the CEO of Capbase. Greg, thanks for being with us. Welcome to the podcast.
Thanks for having me.
How much did I butcher your last name, by the way?
In America, I go by Greg Miaskiewicz, which is the highly Americanized version. I'm originally from Poland, and I long ago gave up on people pronouncing Grzegorz Miaskiewicz correctly.
Yeah, I'm not gonna hazard a guess at that either. So we'll just go with the Americanized version on this podcast, even though I am not American. But yeah, thanks for being with us. We always like to just start by kind of getting an overview of your personal backgrounds. You've been running Capbase now for 4 years, I guess. How did you give us the overview of your resume, Greg, and how you came to launch Capbase?
I've worked in startups for a very long time. My way of arriving at working in technology is very roundabout and indirect. So I think that story is worth telling, especially because I think there are more and more successful founders like me who studied the humanities. Like one of the founders of Slack and a lot of other, founders, some of the smartest VCs I've met, they studied philosophy.
Yeah.
I studied philosophy and other things in the humanities, but what does philosophy teach you is really how to be a systems thinker, how to approach problems from many different perspectives, and how to compare different solutions. What are the advantages, disadvantages? What are the logical problems with certain approaches? It's really what assumptions go into a certain way of looking at the world?
I'm a fellow humanities student. I studied history. And for me, what history teaches you, it's drilled into you all the way through middle school, high school, college. I studied it in university for 3 years. And what you kind of, the biggest lesson I think you learn in history is every historical source, the author of that source is coming at something from their own perspective. And so as you kind of study philosophy and learn kind of systems thinking, for me, studying history has taught me the kind of empathy and just to kind of always try to assess, okay, what's this person's angle? Where are they coming at this conversation from? Which then I think and actually in my role in business development, I think that's actually a really useful kind of skill and way of thinking to have.
It's you're forced to ask the question behind the question. Like if someone's asking you about something,
exactly.
It's probably, if you want to give them an adequate answer, you need to know what they're trying to really address, what they're really getting at.
Yeah.
And you can't just take the words at face value. You almost have to read from the history, of this person and their background, what they're actually getting at.
Exactly. So you studied philosophy, taught you systems thinking, and that's been extremely useful for your kind of journey.
It's useful as a founder because you're willing a reality into existence that didn't exist before. I mean, especially when it's really more companies that are category defining, especially if you're making a SaaS tool that's a 5x better version of Salesforce, you don't really have to view the world from a philosophical lens. If you want to build a product for a category that did not exist before, or creates a new category out of 6 or 7 products that existed before, then studying philosophy is great.
Can you just say more about, just kind of be explicit about why that is?
Because you have to understand what assumptions go into a vision of the world, and you have to rigorously test those assumptions from a logical and empirical reasoning perspective.
So when you're starting a new category or kind of doing something a little more disruptive, then challenging of kind of first principles thinking that's kind of been taken for granted is more important. Whereas, if you're just kind of building a tool on top of existing infrastructure, the Salesforce example that you mentioned, you're not really challenging first principles thinking as much. So it's kind of less important.
I think reasoning from first principles is actually the most important skill for anyone trying to build things, even like if you were working in product management. And the reason I say that, and even if you're an engineer, like the reason I say that, let's just go to the engineer example, because it seems like the most non-obvious thing to say. You should study philosophy and epistemology or understand how logical systems work if you're an engineer trying to, I don't know, process some data 10x faster.
Right.
Well, why is one algorithm better than the other? Can you reason from first principles why one approach would necessarily, I don't know, cause more bugs because there's more state stored in the code? Could you reason from, just logical reasoning, like this is going to store more things in memory that don't need to be stored in memory, or we are writing more frequently to the database than we need to? We could write in a more modular fashion. Those are really meta problems. They're not problems of optimizing a code, like a specific piece of code. They're a problem of what assumptions did my code make and which of those assumptions were wrong. And then you can actually come up with a refactor that gives you that exponential gain in terms of efficiency, or exponential gain in terms of resilience of the software systems you're building and the architecture.
I love that. And so, so you studied philosophy, which has been the perfect foundation for your career. And this is your second rodeo, I believe, right? So what was the first company you started? Talk us through the journey there. And then
that was a very philosophical company. I was like, what makes a human? And how can you identify if someone's a human or not without them knowing you're testing them? So a passive Turing test is what we developed.
Turing test is, came to mind.
And what we did, so it's an interesting thing. I'd worked in e-commerce and I'd worked in ad tech, and bots cause all kinds of problems in both e-commerce and ad tech with regards to fraud. Also a problem in financial services with account takeover and so on. What I'd noticed is that most of the vendors in the space, when the time I started working on the company at least, they did not know what a bot looked like at the client level. Like your browser is a client, a mobile app is a client. Well, how does a bot client differ? How is their on-page behavior different, but also how is the technology stack different? And it turns out that I also had written a lot of automation scripts for automating testing for mobile and desktop apps in prior engineering roles. So I knew a lot about how to build bots. And I had this hunch that bots really, they had a hard time looking like a human if you looked close enough. And we started developing the software and testing it. We realized that all of our assumptions about what would be useful heuristics for distinguishing between humans and bots were mostly wrong and not useful. And so what we did is
a heuristic that you thought would be a good differentiator, and then it turned out to be wrong.
So there are ways of detecting, for example, at the time it was Phantom.js because there was no like headless Chrome for browser automation. But all of those things were easy to get around. Like you could fix them with very minimal effort. Like you could patch over the settings in Phantom.js to make it, so that looking at A, B, and C signals would look like a normal Chrome browser. And we realized there's a lot of low-hanging fruit, and maybe 20 or 30% of bot writers are lazy enough that the low-hanging fruit is effective.
And every little helps.
And then everything else, you want to catch more bots, you have to become more and more sophisticated.
Right.
And so what we developed that actually what was interesting is we really used the scientific method to our advantage. We bought a bunch of botnet traffic on the dark web. We sent it to fake websites, which were like content farm websites. Like one of the ones I remember, because hilariously, the lawyers, when we sold our company, the lawyers from the acquiring company asked me about, like, what do you do with this domain? And I was like, well, trimtricks.net is our site of #1 diet tips, which serves ads from this ad network that is a fake ad network for fake other products. And then we also control the landing pages for all those fake products. So that's the other domain names that you are seeing. And so what did we do there is, we basically tested for false negatives. And then we also would have humans testing in a variety of ways, which some of those were kind of funny because we tricked people into giving us mouse movement data. And, like we made janky web games and got people to play them, and some of them went mini viral, and we were just looking for data for testing. Like, hey, we just want to know what humans look like.
Turns out you're a pretty good viral game developer as a side hustle.
I'll explain what we did there. It was kind of funny, if you want, but it involves juggalos and clowns.
Okay, I really want to Google this now.
We had the domain name wackaclown.net. I don't think it's still active, but so we just needed
All I want to do
pay.
Right now is go to wackaclown.net and whack clown.
It was like I'll explain how it worked, but the general point is we needed human data and we needed bot data, and we needed to separate them.
Yeah.
And then we needed to test for false positive, false negative.
And the company was Swarm Enterprises, right?
Yep.
And you ended up getting acquired by Integral Ad Science?
Yeah. We got bought by one of our largest competitors in the ad tech space. And what we realized about the ad tech space is it's like very much still the agencies call the shots in terms of vendor adoption for new technologies. Agencies don't know how to tell the difference between vaporware and software that actually works. Most of them are very ill-equipped at understanding if the software they are buying works.
Right.
So they make their decisions based on relationships. And if you don't have those relationships, they don't really trust you. It's very much like the world of Mad Men still a little bit, where it's about taking someone on a boat for a party at the Cannes Film Festival, or making sure they have the best steak dinner possible every time they're in New York.
So there's a kind of age-old debate, right? Kind of product versus distribution. I saw Andrew Gazdecki of MicroAcquire kind of tweeting the other day about how kind of distribution trumps product every time. I mean, given what you just said about Mad Men, and it's kind of not what it's who the relationships. Like, did that experience kind of kind of lead you to the conclusion that marketing distribution is more important than the product you build?
Yeah, actually the second time I did a company, like, because we were concerned with building the best bot detection software out there, we objectively built it. Like, we had head-to-head tests against all of the competing vendors that did anything with ad buying at all. White Ops, Double Verify, Moat, Integral. We had head-to-head tests against all of them. We did not lose a single one. And we tied it to conversions, right? Bots don't have credit cards. There's no vanity metrics at the point where you're doing purchase-driven campaigns only.
Right.
You can't pretend that the bots had credit cards, right? So we caught the most fraud and had the best lift on ROI if you used our signal to filter out bot traffic every single time. But turns out if you build the best product, people aren't going to necessarily buy it. And what happened is we'd go to like an ad buying platform demand side platform or supply side platform. And they would do these head-to-head tests, and then eventually they would have to come to make a decision, and someone would, come up with a reasonable point that, hey, this this is going to just create a giant customer support headache, because all of the ad buyers on our platform are using integral or double verify because that's what the ad agencies really want them to do. So if we had a different source of truth as to what we say is a bot or is not a bot, then it's not going to help them. They're just going to have to spend hours and hours explaining to their buyers why they're using a less established vendor that disagrees with their more established preferred vendor at the agencies.
Hmm.
So
then,
the second time around with Capbase, before we had a product in market, I'd already written a short ebook of articles of things that for our blog that are stuff that founders will search for when they go to start their companies.
Yeah.
So we were a media company, publishing company before we were a product.
Right. And so just to kind of round out the story, so you ran Swarm Enterprise for a couple of years. Then you got acquired. You stayed at Integral Ad Science for a couple of years. But as with most of the founders we have on the show, those feet started to itch before too long, and that brings us to Capbase. So you launched a company in 2018, and yeah, it sounds like straight out of the gate, you're kind of, okay, what lessons did we learn from Swarm? Okay, like importance of distribution, marketing. Sounds like that was the playbook from day one, even from day -1 by the sound of it. But we still haven't give us a high level overview on Capbase. Most listeners probably know, but give us the quick 101 on what you guys do.
We make it easier to start a company, hire people, issue equity, raise funds, and keep your company compliant. Other software that's out there typically does one or two things, like manage a cap table, deal with board management, deal with document signing, or you have point solutions for just incorporating a company. Because you have a lot of these, systems that do only one or two things, and they're not connected together, it's a giant hassle to enter all this data in, and there's a lot of inaccurate data. So think about the common admin stack for a company. Let's say you want to hire someone and issue equity to that employee as part of their equity comp. First, you generate the contracts. Might be a law firm, could be software. It's highly templatized documents. 2, use document signing software to sign your contracts. 3, you manually copy your signed contracts into Google Drive or Dropbox. Most founders fail to do this, and then they pay their lawyers like $40K or $50K to clean up everything when they go through a first real diligence. 4th, you have to process payments for the equity award. It's very messy when you're dealing with stuff before options, because it's technically the shares have already been granted and you have a repurchase right. And so I've worked at many companies where 1 or 2% of the company was dead equity because they failed to pay someone like $10 when they quit the company. Like one of the early founding engineers. And they quit the company before the shares were fully vested. Next, you update. So payments are a bit messy. The accounting is a little tricky, but it's largely dealt with manually. 5th, you update a cap table. That's also generally done manually. Like I have dozen plus entities in Carta. Why? I have 2 entities in real life, but like my legal name, going back to the start of this conversation, is Grzegorz Miaskiewicz. I made the mistake of putting that in the LLC I use for managing angel investments. So now I have 20, dozens of entities. They're all just misspellings. And every year when I get my K1s, I have to be like, hi, accountant, these are all the same thing. I know it doesn't look like that, but every year. And they don't care about me because I'm poor by investor standards. I invest a few $1,000s to my friends' companies. They're like, the customer support people don't respond to me.
Yeah.
So at 6 after this, you have the board approvals of the share awards. I've worked at multiple companies where they had huge HR problems due to the fact that they did not approve share awards in time, and some senior executive who was supposed to get a strike price of $150 got a strike price of $4 on their options and just pieced out and left. Because the board didn't approve the share award in time before the next FMV came through. Because the board meets once a quarter and signs off in the board minutes on all the share awards for the employees.
Oof, that's pretty miserable.
7th in the admin stack is you have compliance. You're hiring an employee in a state you haven't hired anyone in before, and they're a W-2 employee in the US. You have to register to do business in that state, have ongoing compliance filings. You register for payroll and unemployment tax. 2nd, you have to file various IRS forms when the employee exercises stock options. So there's Form 701. If stock options are exercised, if you early exercise any equity, you have to file Form 83B. Then you set up payroll. Then you update your business insurance, because it's largely, the coverage is derived from where and when, where the work is being done and how much people are being paid. So there's 9 layers. 1 or 2 of the founders is doing this themselves until they're at least 6 months after Series A, and they've hired like in-house legal, in-house HR admins. They usually do it poorly, and they usually mess things up. And in the best case, they just end up spending thousands of dollars on lawyers that they didn't need to spend, cleaning things up that they messed up. In the worst case, they've messed it up so much that it's not an investable entity. I'll explain how that could happen, right? So let's say you had a bunch of engineers working for the company. The company went through a rough patch. It fired a bunch of people, but it turned things around, built the team back up again after layoffs, built up the business. It turns out they go, they're ready to raise their A round. And it turns out that none of the engineers had signed intellectual property assignment agreements. And sometimes you're able to you can get people to sign that ex post facto. But if you fired them on bad terms in a layoff, they technically own the code that's part of your product. They never assigned it to the corporation, so why would anyone invest in the corporation that's building a product on top of code with dubious IP ownership?
Right. So that's a good example of like a mistake, right? Like it's like, again, we were talking before we started the Silicon Valley episode, but that's obviously if you've watched that show when Richard Hendricks is getting in this lawsuit with Gavin Belson because he started Pied Piper on his own laptop. So that's one that's kind of famous in the world of entertainment. But what are and I mean, you talked about kind of the legal fees that come because you didn't put the document on the Google Drive or what have you. What are the other common mistakes that you've seen early stage founders make that you're trying to help them?
Well, a lot of founders get bad advice, like where they're told that an LLC will be better for them for their personal taxes to avoid double taxation.
Yeah.
But that's a complete myth in the sense that for 4 or 5 years, your startup is likely not going to be profitable. So there are no profits to pass through to your personal income taxes.
Right.
And meanwhile, the US federal tax statutes strongly incentivize the creation of stock corporations. QSBS, I don't know if most people who listen to the podcast know about the boring details of US tax law. Qualified small business stock is stock in a stock corporation that has less than $50 million in assets at the time of the acquisition of those shares. Then if you hold the shares for 5 years before selling, either, I believe it's 10x the principal invested or $10 million is exempt from federal income tax. So, and then anything that exceeds that, whatever the threshold is, can be deferred on taxation as long as it is invested into other QSBS companies. So this creates a strong incentive for a founder has an exit. They get to keep $10 million tax-free if it's more than 5 years in. And then anything that exceeds that $10 million, they will be able to invest into their friend's startup. So there's this huge tax incentive to becoming an angel investor if you have an exit.
I mean, this is like, you're really obviously kind of, with the complexity that you're kind of shining a spotlight on here, right? You're just like basically building a very strong case for why companies should use Capbase, because this stuff is complex. You got 1,000 fires burning, especially if you're a first-time founder. You haven't like had people walk you through this before, and there's just like so much to kind of complexity to wrap your head around, and you guys have wrapped your head around it, and you can nudge founders, okay, do this now.
Yeah, we send them an annoying drip campaign with like 10 different messages if they don't file, if they're late on filing their 83B election with the IRS.
It's a lot less annoying than having to pay a lawyer $40,000 because you didn't save the contract,
or you didn't file your 83B election, so you were taxed at it as ordinary income when you go to sell your company.
Right. Yeah, I've spoken to a couple of founders that have been stung by that and probably wish they used Capbase.
We walk founders through all of the things that they need to do. I mean, like people, I guess, let's go back a step. Like founders are very one-track mind. They're like, oh, okay, I got to incorporate. Someone told me I need to incorporate in Delaware because no one will invest in me if I don't incorporate in Delaware. That doesn't mean they actually, this is someone who's already more well-educated than half of first-time founders.
Yeah.
A lot of them start LLCs, or I don't know, they expect someone's going to invest in a Georgia S Corp. It's like, no one's going to do that.
Just on the LLC versus the sequel question, are you guys then focused exclusively or primarily on like venture path startups, or like would you work with a restaurant or a Main Street business? For him,
no, we just work with someone who needs a corporation and needs to manage equity, whether that's internal shareholders or preferred shareholders in a venture-backed startup. And there's plenty of people who just need to manage equity in a project that might not necessarily need so much outside capital. But they want equity comp to be part of that for employees. And one of the big downsides of LLCs that many people also don't realize is you cannot have membership interests in an LLC and be a shareholder while being an employee, W-2 employee. It is not allowed under the US tax code. So if you want to use equity compensation in an LLC, your only choice is profit interests, which is a nightmare. Mm-hmm. Then there's also this shadow equity where it's like you get a right to X dollars of money in the case the company is acquired. But you can't actually give shares to the employees. And the taxation of those shares is most likely going to be as ordinary income if the company sells. So if you want to if equity compensation and equity issuance to employees is a key part of how you're going to develop your company, even if you're bootstrapping, you should not be an LLC. Because it creates a lot of complexity, and you're not, I mean, the concept of giving equity in an LLC to an employee it's not real equity. It's not shares. They're not taxed as shares. It's a shadow equity where you are entitled to a certain pro rata distribution from an acquisition of the LLC.
I want to talk about marketing. Before we get there, a couple of questions on the product. As you're talking through this, it's like, it's complicated stuff, right? And there's kind of nuances and complexities, and there's probably a lot that's like you can generalize across like all companies, all industries, whatever. But there are some things which is obviously like, okay, based on the specific circumstances that this founder is in versus this founder, a different kind of path might be the right one. So are you kind of aiming to make Capbase kind of, or to what extent is it like it's software and it's all kind of self-serve, and we're building this kind of beautiful, like, you never talk to a human, you just kind of work your way through the product, versus like
we tried that, by the way, and then it wasn't a good idea because founders have too many questions when they're first starting their companies, especially first-time founders. And so we do like superhuman style, where you set up your account and pay while on the phone with someone and share your screen.
Yeah.
And we did that just for the onboarding initial setup.
Mhm.
We're gradually testing out pure self-serve, but when we started out doing self-serve, we realized that founders don't understand how common shares work. They don't realize that investors don't generally want common shares. They read misleading articles from Delaware registered agent companies that the number of shares matter for your franchise tax calculation, but there's actually two methods of calculating franchise tax, and no, you won't pay $40,000 in tax just because you authorize 10 million shares.
Mm-hmm.
So they read misleading articles, so they're like, we had self-serve during our private beta, and someone signed up and they authorized 3 shares, one for themselves and each of their 2 co-founders.
Mm-hmm.
Like we didn't have warning.
Taxes.
Yeah, we didn't have warning messages as to like why this is a bad idea, and now we have this project which. I mean, we mean this in a loving way, but one of our designers who is in Eastern Europe, they're a little blunt. The project got named internally Stupid Alerts. Like, hey, you're about to do something stupid. We should alert you.
That's funny. I like that. That is blunt.
So we might go back to pure self-serve, but most of our customers seem to like talking with a human, and we realize that if we put a lot of stuff in the UI for them to read and educate them, most of them won't read it.
Yeah. How did you, so you set out with this desire to build kind of purely self-serve. It must have been a little jarring to kind of, or maybe not. Maybe it was just like, hey, there's this, we're getting this feedback from users, we're seeing it in the data. So it was actually a very natural thing to just kind of, say, okay, we're gonna go down the road of kind of human interaction to complement the product.
It was a decision that we made after getting the data and the feedback. And
was it a hard decision because you set your sights on, let's build a beautiful product, and we obviously invest so much time in architecture and the design.
I mean, our product's complicated. It's not going to be perfect the first time, and a human in the loop is a good way of talking to people and getting data. So like I observed everyone. I did our first 50 signups, and I observed everyone using our customer onboarding and noticed all of the things that were confusing to them. And then I fixed it and put it in our product roadmap to make these improvements. Then the stupid alerts is the final phase of that. Like hey, most companies have millions of shares, not 3. This isn't really that helpful for reducing your taxes, just so you know. Here's an article.
I love that. One of my favorite podcast episodes ever is when Reid Hoffman interviews Brian Chesky about doing things that don't scale. And just to hear Brian Chesky talk about how the early days of Airbnb, they could like meet with all of their users like individually, one-on-one, and that kind of first, hands like experience and interaction with users is incredibly valuable. And obviously as you scale, you kind of lose that, and it's harder and harder to do that. But yeah, to kind of hear you talk about going through the flow with the first 50 companies, 50 founders.
I mean, I just had really great UX research for free. It was fine.
Yeah, exactly.
I didn't mind.
One question we always kind of curious, Wefunder, platform to help founders raise capital. We're always interested in the capital journeys of founders. Both for Swarm and for Capbase. How have you raised capital? What's that journey look like?
Well, when it came to Swarm, I had no idea what I was doing. I knew maybe 3 or 4 people who had any connects to angel investors. I did not know how to do TAM sizing in any meaningful way. My first decks were terrible. And I don't think I ever had a good deck for Swarm for market size, because it's really not, maybe it's not a great market, to be honest, in retrospect. Never had a great TAM slide. We raised some money from people who are security professionals. We did, Y Combinator had a program called YC Fellowship for super early stage companies. Didn't even have a product in market, but it was half the money almost as many AWS credits, and the money was an equity-free grant unless you sold for 9 figures or more. So we did that. It was fine. YC fellowship. And we sold before finishing the YC fellowship and never did demo day. Mm-hmm. So we gave up very little of the company. My co-founder and I owned more than 90% of it.
Wow, cool.
Maybe even 90, 95 when we sold the company. So it worked out okay for us.
Yeah,
that was a mostly bootstrapped company. We got pretty close to 6-figure MRR before we sold with a couple customers. Wow. So it wasn't, we were good at getting, we're not good at getting sales and volume.
Per what you were talking about before, that even having a better product, challenge of distribution.
Yeah, so when it came the second time around, I already had all those investors who I talked to who didn't back my first startup, but saw I had an exit. And then Integral itself was bought by Vista Private Equity in 2018 for almost $1 billion. So the fact that I basically led up R&D for one of the 3 product lines of $1 billion company post-acquisition, as a founder, I was not a noob and I was much more investable.
Right.
At the same time, I started also doing a small amount of angel investing, occasionally directly, mostly through my friends' rolling funds or syndicates.
Right.
And with that, I actually was on the other side. So I was really good at writing a deck the second time around.
Because you'd seen a bunch of decks of founders and you kind of, seen from the other side what worked and what didn't.
But the first time around, I made a bunch of rookie mistakes. We built really cool tech and we got acquired. So we were lucky. We didn't have much of a real scalable business there. And I think the fact that we had multiple acquisition deals on the table, it is not because of merit. It's because I worked in Silicon Valley for a long time and I'm very well connected. That's the only reason.
We made a couple of rookie mistakes. Can you share one or two of those?
Well, like that if you build it, they will come. Not doing
you're talking
marketing.
About rookie mistakes with building the company as opposed to the fundraising?
Yeah.
Got it.
Just everything about building a company and making a case for the company being investable. We made a bunch of rookie mistakes with Swarm that I avoided the second time around.
And with respect to Capbase, so now obviously easier for you to raise money. Your pitch deck's stronger. You're building the company, kind of having learned some of the mistakes from Swarm. You're much better connected to investors. So, how's the capital journey looked at Capbase over the last few years?
We raised $1.5 million in pre-seed. It's pretty easy to do. Some of that we did in tranches from the same people. Like we made progress. They liked what we were demoing to them, so they gave us more money. So we did a very slow moving rolling raise, gradually increasing the cap.
And was that a good route, would you say? Would you recommend that?
Yeah. I mean, you should just always raise money when you're early, and you should raise money from people who are smart and helpful. Some of those early 25K checks, those people have been much more helpful to us than later stage investors. Not that the later investors aren't trying to help. It's I feel the people who are doing the smaller checks and have less leverage in investing are often the people who are closer to the actual experience of founding and running a company. So they have a lot of material advice that proves useful to you when you're a founder early on.
Yeah. And maybe they're like writing smaller checks and they still kind of proving themselves as investors, and so they're kind of hungrier to prove their worth, so that you'll kind of recommend them as investors to other founders, and they can kind of build out their portfolio and reputation. Well, this is a nice segue. This week we're super excited to be launching communityround.com, which is our attempt to try to reposition the whole quotes equity crowdfunding industry. We don't really like the term equity crowdfunding. Our CEO founder has kind of hated it from day one, because crowdfunding, it's like, who wants to raise from a crowd? It's impersonal. It sounds like Kickstarter. But running a community around, our take, and I'm curious to get yours, but our take is, enabling your customers and your community to invest in you, is a very natural thing to do. Who doesn't want to delight their customers by letting them invest? Who doesn't want to build stronger ties with their community? And so, curious. We had a really exciting, successful raise of Replit over the weekend. They maxed out their $5 million, which is the annual limit you can raise through this regulation crowdfunding exemption. They maxed that out in a few hours on Saturday, which is really exciting. But kind of curious on your take. Is this and just your genuine, honest take? And
so we've thought of different ways of doing this. It's really legally complicated. We thought of, I don't know if you know the concept from crypto of token airdrops, where you gift tokens to people who you think are influential in the crypto world, and then will seed your network. So we thought of the same idea, but customer share drops. To create basically an early adopter bonus. The first customer of the first 100 customers, let's say the first one gets 100 shares, the second one gets 99, going down. So this is one idea we had. Or just the first, first 500 customers get 10 shares, whatever it is.
Yeah, I mean, what Mercury Bank did was to say, if you are, they only let customers invest, right? So it's like, if you're a customer, you get to invest, but you still have to pay, but you're investing on the same terms as Andreessen Horowitz, but we're only opening this up to customers. So, and maybe you give them a discount or some credit towards kind of investing. So Mercury kind of tried to do a similar thing.
So I'm all for trying to figure out how to make your community invested in you and your success and your company's success. There's plenty of people who may not be accredited investors who are in my network who are like, hey, could I invest in your startup? Like, I actually believe in what you are doing and believe in you as a person. And I have to, most of the time, unless I wanted to go through the trouble of going through Republic or Wefunder, any equity crowdfunding platform, it would be very complicated and annoying to do, and probably not worth it for us.
Yeah. So, and with when you say the hassle of the Wefunder round, you're talking about the Form C filing and the financials.
Yeah, just doing all of the preparation for it. So, like, taking an unaccredited investor directly onto your cap table is probably not great. Doing it through a community round or crowdfund through the Reg CFA Plus is a little less annoying from a regulatory perspective.
And we can do one SPV.
Yeah. But it's still it's not really as easy as if someone is an accredited investor just saying like, yeah, cool, just write us a check.
Yeah, you need to do the biggest kind of downside these days is because the SEC obviously made some nice improvements, increase the cap to 5 million, allow individual investors to be rolled up to one SPV, and then the testing orders allows you to launch a campaign very easily without any financial disclosures. But yeah, before you close on the money, you need to file a Form C, and as you probably know, for the Form C filing, you need if you're doing more than $1 million, you need audited financials. And that's probably, I expect, what you're referring to when it's like, you don't need that. You don't need that for Regulation D.
Yeah. So there are different, I think in the UK, actually, equity crowdfunding took off way faster because the laws are less strict with regards to who can invest, how much the minimums or minimum income thresholds, or what percentage of your income you can invest into equity crowdfunding platforms and so on.
Totally. And I think like for the first 5 years of regulation crowdfunding being legal in the US from 2016 to 2021, when the SEC made the updates to the laws, the growth was also slow because you couldn't even launch and test in the waters until you had got reviewed financials, and you could only raise $1 million, and we couldn't do SPVs. And so you put all those things together, and then it was like relatively unappealing for startups. Now I think we're seeing more and more examples. Mercury, Replit, the latest one, where founders are saying, okay, given we can now bring on thousands of our customers as investors. For some folks, they think the juice is worth the squeeze, but sounds like maybe not for Capbase, give where you guys are, but we're hoping.
It's like anything that involves putting together normal financials. It's like that's a thing you do at growth stage typically.
But do you really? You mean just because of the hassle of it, or are you kind of worried about the?
It's the wrong metric. It's the wrong metric to even bother collecting or reporting.
But what's the downside in kind of
it's just tedious, expensive.
Okay. It's just like the hassle of putting together.
Dealing with it's like putting together a tax return.
Got it.
Do you really want to do it?
Definitely not.
Reminds me that this is a thing that it's kind of funny. Like every single year, my angel list K1s are always late. And I have to file for a tax extension every single year. Mm-hmm. They've never arrived on time. Right. I got 1 out of the 4 on time one year.
Yeah.
And then, so these types of things, when you're investing, like even as an independent angel investor, it's like a very you end up dreading dealing with taxes and dealing with accounting because it's really messy and very disjointed experience. And
well, we had Wasim from Pilot on the podcast a couple of weeks ago. I saw you had a partnership with them that you announced recently. So maybe if your startup has had your books nicely maintained by Pilot, then put in the hassle of putting together the CPA review for the financials is relatively easier. The cost is a little less. And I mean,
so we actually switched to Pilot from Bench, and Bench is a great team, but they ended up, I think the way they do their financials do accounting doesn't really make sense that much for SaaS businesses. So we switched over to Pilot.
Love it. Well, for me, I think we're kind of zeroing in on, as you say, like the main kind of downside for founders is like, and for me, there's two things. There's like both the time and the hassle of putting together the financials, which depending on the complexity of your finances, will be kind of a different level of cost. And then some founders are reluctant for that information to be in the public domain. So that's the other kind of consideration that folks sometimes.
Well, I'll put it this way. This was not their intent when they syndicated deals on AngelList or on RUV Alliance, but I have a really unnecessary amount of detailed knowledge of the product roadmap and financials of some competing products or related products that might not be directly competitive now, what their ACV is, and all of this information, right, because they're syndicating a deal. Not even equity crowdfunding, way smaller reach, like you're talking a few hundred people. And that wasn't what they intended. And to put it another way, enough people from Carta's BD and M&A and Corp Dev teams are LPs in virtually every fintech and legal tech fund that exists out there. I guess legal tech funds are a fairly new thing. They didn't exist 5-10 years ago at all. But they're LPs in all these funds. So, I mean, if I go to pitch this fund, I am effectively always spilling the beans.
You heard it here from Greg. there's no difference in financial disclosure having your financials kind of publicly in the database with the SEC versus just kind of raising through an AngelList RUV or kind of pitching funds, because Carter's LPs are in those anyway. And so, there's no kind of downside to the transparency and
not exactly what I said.
That's all we've got time for, Greg. No, just kidding. But I mean, for me, it's kind of less about like, oh, well, you're going to disclose financials anyway if you raise the conventional route. It's more like, I mean, and obviously every founder's different, but like the financials are high level. They're usually, by the time, like if you launched a raise now, and wrapped it up by the end of April, you only knew financials through the end of 2020. So they're like a year and a half old. And does it really matter if your competitors see your revenue from a year and a half ago? And some founders will say yes, it does. But obviously, a lot of founders are kind of saying,
yeah, I mean, I wouldn't care about 2020. We made barely any money. It's fine.
Exactly.
We made $5,000 and spent a bunch. Like, what do you want to know?
It's advantage, Greg. You get to mislead. You get to mislead the competition with how small you are. Throw them off the scent. But yeah, no, this is really for me the one downside. And so then it kind of turns for founders to evaluate, okay, the upside is letting your customers and community, thousands of people invest in you, build kind of stronger relationships with them. And then the downside is, okay, the cost and the time and the hassle of the financials, potentially publicly sharing them. So that's the trade-off that we're down to now. And it's cool for us at Wefunder because a couple of years ago, I joined the company in 2018, and at the time, it was like, well, the downside is you can only raise $1 million. The downside is when I first started, it was like, we're going to put 2,000 lines on your cap table. The downside is you got to wait a month to start raising because we can't do testing the waters. And so we've kind of chipped away at a number of the downsides to this, and so now the downsides are, I think, a lot less and kind of clearly enumerated as we're talking about with the financials. And so we're really excited about this launch of this community around concepts as a way to just try to increase the credibility and prestige of raising from your community alongside conventional investors. And thanks for the kind of open dialogue on this as a way of raising money. And we hope many Capbase clients over the coming months and years will choose to open up their ownership to their customers and their community. But Greg, we are over time, so this has been a really, really fascinating conversation. We've gone in so many different directions. I've really loved it. I've learned a lot. One thing that we ask all guests who come on the podcast to end on, and you've already thrown out so many nuggets, but maybe just give us one to end with, a piece of advice that you would give to a founder as they're building their startup.
Well, it's really a marathon, not a sprint. And a lot of founders try to do too much and get too far along without testing their hypotheses. Even if you know you're going to build a product that solves X, Y, and Z problems, the nitty-gritty of those details you don't know. And you're going to have to constantly be testing your hypothesis and knowing, and you'll have good ideas and you'll have instincts, but you're not going to be right 100% of the time. There's always going to be setbacks. And the thing I tell everyone who joins us as an employee at Capbase is we expect you to fail at most things you do. We expect you just to learn, though, and we expect you not to spend that much time failing. So fail really quickly, learn from what you're failing, or from your failures and how you can do better. And the fifth time, you'll knock it out of the park. Most of the code you write will be thrown away. Most of the copy you write, if you're a marketing copywriter, will be thrown away. Just that is the expectation at a startup. And so for the employees, it's less of a roller coaster, but it's really about doing moving faster and always thinking and testing your assumptions and recalibrating based on what you learn. What you don't want is a company where you're basically driven by the founder's vision and you don't have any checks and balances against their confirmation bias of only seeing the evidence that fits their worldview. That's where most companies fail. They don't actually validate something about how their customers behave, about the market, and they continue down a path that isn't the right path. They don't know. This is why when you're doing Y Combinator, every single week, the mentors, partners will ask, how many users did you speak to?
Mm-hmm.
The reason you speak to users is because that's the only way you're going to know you're building the right thing. You can make a lot of assumptions about users, what they know. I've learned this the hard way going back to our failed attempts at self-serve with that company with 3 shares. I made a lot of assumptions about what our users know.
Yeah.
Or don't know.
Yeah. Well, that's a great note to end on. Greg, thanks so much. This has been such a fun and rich conversation. Really appreciate you taking so much time, and look forward to working together. We have this partnership between Wefunder and Capbase. I think it's a really natural fit. If Capbase customers are incorporating companies and starting on their journey, hopefully we can help get them funded on Wefunder, and hopefully we can help some of our founders avoid some of the mistakes that you've drawn attention to on this podcast by using Capbase. So really appreciate you coming on, and we'll speak soon.
Hi, thanks for having me.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you're ready, Wefunder's here to help. Be sure to like and leave a review, gang.